Welcome back to Investing Talk Podcast.
Today, we are looking at a company that is arguably one of the most interesting plays in the precious metals sector right now. We are taking a look at Pan American Silver, ticker PAAS. And I want to frame this right off the bat. This isn't just another, dry mining stock discussion. We are looking at a massive silver play that has just released its preliminary 2025 results and its guidance for 2026. And honestly, the market reaction has been telling.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find us and lets us keep doing these.
So just to set the scene, today is Saturday, January 24, 2026. We are looking at fresh data that just dropped this week regarding their fiscal year 2025 performance. And the core hook here, the so what, if you will, is that this is a company that just crushed its production guidance in a rising silver environment. And maybe even more surprisingly, is sitting on a massive cash pile.
Okay, let's slow down and unpack that for a second. Because usually when I look at miners, the story is pretty consistent. Cash burn, holes in the ground, and, maybe next year we'll make money. But you're telling me Pan American Silver is actually delivering right now.
They really are. And it's not just delivering, it's outperforming. Let's look at the headline number first. For the fiscal year 2025, their attributable silver production hit 22.8 million ounces.
Okay, 22.8 million sounds like a lot of metal, but I need some context. Is that a lot for them? How does that compare to what they promised they would do?
That's the key question. Their own updated guidance range was 22.0 to 22.5 million ounces.
So they beat the top end.
They beat the top end of their own forecast. You have to understand, in the mining industry, coming in above the upper band of guidance is, well, it's incredibly rare. Usually you hear excuses about weather or a labor strike or grade quality issues. Beating the top end is a significant signal of operational efficiency.
That is rare. I feel like every earnings call I listen to in this sector starts with an apology for missing targets. So what was the driver here? Was it just dumb luck, or was there a specific asset doing the heavy lifting?
It definitely wasn't luck. It was the Juanicipio mine. This asset is really becoming the MVP of their portfolio. That single mine drove a record Q4 output of 7.3 million ounces.
Juanicipio. Right. I've heard that name floating around. Why is that specific mine such a big deal?
It's a high-grade asset. In mining, grade is king. It means you get more silver for every ton of rock you crush. Now that they have fully integrated it, it's really starting to show up in the production profile. It's efficient, it's high volume, and it's essentially the engine room of the company right now.
So Juanicipio is the star player. But I noticed in the notes they aren't just a silver pony, right? They have some gold exposure, too.
They do. They produced 742.2 thousand ounces of gold in 2025. That was squarely within their targets. So think of it this way. You have the silver production beating expectations, giving you that upside surprise, and the gold production doing exactly what it was supposed to do, providing stability. It's a very robust picture.
Here's where I get a little skeptical, though. Production is great, sure, we love metal coming out of the ground, but usually ramping up production costs a fortune. I've seen companies produce record ounces and go broke doing it. What does the bank account look like?
This is where the story gets even better. The balance sheet looks like a fortress. In this fluctuating interest rate environment, liquidity is everything. As of December 31st, 2025, their cash and short-term investments stood at $1.319 billion.
Whoa, hold on. $1.3 billion. That is a staggering amount of liquidity for a miner of this size. Just to put that in perspective, how much did that grow recently?
That pile grew by $408 million just from the third quarter.
In one quarter?
In a single quarter.
Yeah.
A massive jump.
So let me get this straight. They are basically Scrooge McDuck swimming in it right now. $400 million in one quarter.
Essentially, yes. And it speaks to the cash-generating capability of these assets when metal prices are cooperating. Their Q3 revenue was up 19% year-over-year to $854.6 million. It proves that they aren't just digging holes, they are selling the metal, making good margins, and actually stacking cash.
That cash pile is interesting because it gives them options. They can pay dividends, they can buy back stock, or they can acquire someone else. But let's look forward. 2025 is in the books. The market is a forward-looking machine. What are they telling us about 2026? Are they going to take a breather?
No breather here. The 2026 outlook is where the growth story really solidifies. They are projecting attributable silver production of 25.0 to 27.0 million ounces.
Wait, let me do the math there. They just did 22.8 million, which was a beat. And now they are saying next year we're going to do up to 27 million. That is a huge step up. Isn't that risky, promising that much growth?
It is a significant ramp up, and there is always execution risk. But it's important to note the cadence of that production. They've signaled that it is weighted to the second half of the year. So for investors, that means patience might be required in Q1 and Q2.
Ah, the classic hockey stick projection.
Exactly. The back half of 2026 is expected to be very heavy on output.
That's a crucial detail for anyone listening. If Q1 comes in a little light, don't panic sell, because the guidance is explicitly backloaded. Now, I want to talk about this concept of a moat. I know it's weird to talk about moats in mining because a commodity is a commodity. Silver is silver. My silver is the same as your silver. How does Pan American Silver protect its position against a giant like, say, Agnico Eagle?
The moat here isn't the product, it's the asset quality and the lifespan. One, a CPO isn't just producing a lot, it's a long-life asset. This allows them to have visibility for years, not just quarters. When you have high-grade, long-life mines, your cost per ounce generally stays more competitive because you aren't constantly scrambling to develop new, lower-grade pits just to keep the lights on.
So they aren't on that exploration treadmill where they have to find a new mine every year just to survive.
Precisely. It gives them a strategic advantage. Cost-efficient, expandable silver production, exactly at a time when silver prices are finding support.
Okay, so the business fundamentals are rock solid, but does the stock price actually reflect that reality, or is the market ignoring them? Let's pivot and talk about the charts.
Oh, the market cares. I was looking at the reaction after this news dropped. The shares popped 9.6% immediately after the output beat and the guidance release. That is a massive single-day move for a major miner.
A nearly 10% move in a day is huge. It sounds like the market was maybe sleeping on them a bit.
It validates the thesis that the market was perhaps underestimating their ability to execute. But if you zoom out, this isn't just a one-day wonder.
No, looking at the data here, the stock is already up 13% year-to-date in 2026. And remember, we are only in late January. But if you look back at 2025, they rallied 156%.
That is an incredible run. To rally 156% in a year and then start the next year with another double-digit gain, that shows sustained institutional appetite.
And structurally, looking at the chart, it looks like a rocket ship. It's just refueling. The stock is trading roughly 5% below its 52-week high. But, and this is the kicker, it is over 177% above its lows.
What that tells me is that the trend is firmly established. We are seeing a series of higher highs and higher lows. When a stock consolidates just 5% below a record high after a massive run, that's usually a sign of strength, not exhaustion. It's what technicians call a bullish flag.
Explain that for the non-technical listeners. What is a bullish flag?
Okay, so think of it like this. The flagpole is that massive vertical rally we just saw. The flag is a little period of sideways trading at the top. It basically means sellers are trying to push it down, but buyers are stepping in and holding the line. It usually resolves with another breakout to the upside.
So, interpretation. This signals a breakout above recent levels is likely if the news flow continues. And checking the flow, despite some volatility, there was a 2.64% dip mentioned in the data recently. The net flow is aggressively upward. And obviously, this is tied closely to the underlying commodities. Is silver and gold tank tomorrow? This chart breaks. But right now, the correlation is working in their favor.
Exactly. So we have good fundamentals and we have a strong chart. But let's move on to what the market is thinking. The sentiment. Because sometimes the charts lie or the fundamentals are backward looking. What is the vibe right now?
I put on my data checker hat for this one. The quantitative scoring for the sentiment is strongly bullish.
And that's based on news flow and analyst chatter.
Exactly. We look at the last 5 major headlines between January 23rd and 24th, 2026. 4 out of 5 were decidedly bullish. You don't often see that level of consensus unless the company really delivered a no-doubter quarter.
However, it's not entirely a love fest. There is a bit of a clash happening in the analyst community, which I find fascinating.
Yeah.
It's always better when there is some disagreement. It makes a market.
Oh, it's a total battleground on the price targets. On the bull side, you have Bank of America. On January 23rd, they raised their price target from $68 to $73. Their logic was pretty simple. The 2026 guidance is strong. The production is rising. Buy the stock.
And then you have the celebrity endorsement, right?
You can't ignore the Cramer bounce. Jim Cramer came out on January 22nd and called Pan American Silver the best silver mining company.
Does that actually matter, though? I mean, institutional investors aren't trading off Cramer, are they?
Maybe not the big hedge funds, but retail investors definitely listen. It puts the ticker on the radar of thousands of people who might not follow mining closely. It adds liquidity and volume. But then we had the party pooper.
Jeffries,
the bear in the room.
Right.
On January 22nd, they actually lowered their target to $54 and maintained a hold rating.
That is a massive divergence. Bank of America is at $73. Jefferies is at $54. That's nearly a $20 spread. Why is Jefferies so skeptical? What are they seeing that BofA isn't?
That's the big question. We'll get into their specific arguments in a second, but generally, they're looking at the same data and seeing risks where BofA sees opportunity.
Yeah.
But looking at the institutional vibe overall, even though we didn't see specific cluster buying in the 13Fs recently, the implied optimism is there. The average analyst target is sitting roughly around $57, which is still supportive, but BofA is definitely the outlier on the high side.
This raises an important question. If the fundamentals are good and the chart is good, why would Jefferies cut their target? Now, let's look at the risks, because no investment is perfect.
Okay, I'm going to play the skeptic here. I want to channel my inner Jefferies analyst. The 2026 guidance looks great on the top line, more ounces, but it is not free money. The cost to get those ounces out of the ground is rising.
This is the industry-wide plague right now. Inflation. It hits miners hard because they use fuel, chemicals, steel, and labor. What are we looking at for cost specifically?
We need to look at AISC all-in sustaining costs.
For those new to miners, can you explain AISC?
Basically, it's the break-even price. It's not just digging the rock. It's the corporate overhead, the sustaining capital to keep the mine running, the taxes, everything. For silver, they're guiding $15.75 to $18.25 per ounce for 2026.
That is creeping up. I mean, if silver prices were to drop to, say, $22 or $23, those margins start to get squeezed pretty tight. You aren't making that much profit per ounce anymore.
Exactly. And it's not just the operating costs. The CapEx capital expenditure is high. They're projecting to spend between $515 million and $550 million in 2026. That is over $500 million of cash going back into the ground or into machinery. That eats into that free cash flow we were celebrating earlier.
And this connects to the Jefferies argument. Their caution stems from a combination of these factors. They're worried about lower than consensus production volumes. Perhaps they don't believe the full ramp-up story, combined with these higher unit costs and cash taxes.
Right. Think about it. If you produce a little less than you promised, and it costs a little more than you thought, and the tax man takes a bigger cut, suddenly that earnings beat turns into a miss. Jefferies is essentially betting that the execution risk is higher than the market realizes.
There is also the valuation question. When a stock runs 156% in a year, it gets expensive. You can't just buy growth at any price.
It is definitely not cheap. I checked the PE ratio, and it is sitting at 45.95.
A 46 PE for a miner, that is rich. That's tech stock territory.
It's very rich. It's priced for perfection. If you look at something like Guru Focus, their fair value estimate is around $32.07. The stock is trading significantly higher than that. So you are paying a massive premium right now for that future growth and for the optionality on silver prices. If silver doesn't continue to rally, that PE multiple could contract very quickly.
So the stock is essentially a leveraged bet on silver prices staying high or going higher, plus the company executing perfectly on its production ramp. There is very little room for error at 46 times earnings.
Precisely. And we have a catalyst coming up very soon where the rubber meets the road.
We do. The audited Q4 and full year 2025 results are scheduled for February 18th and 19th, 2026.
The market is going to be watching that report like a hawk. Specifically, they will be looking at margins. They beat on production volume, great, but did they do it profitably? If those costs we mentioned, AISC, come in at the high end, we could see a sell-off, even if the production numbers are good.
It's going to be a show-me-the-money moment regarding cost control.
So we've seen the good, the bad, and the expensive. Let's wrap this up. What is the verdict here?
Based on the synthesis of the data, the production beat, and the forward guidance, I'm giving this a bullish score of 8/10.
An 8 out of 10. That is a high confidence score, especially with those risks we just talked about. Walk me through the thesis one last time. Why are you so bullish?
It's a four-pillared thesis. 1. PAAS crushed their 2025 guidance. Execution matters, and they proved they can execute. 2. The $1.3 billion cash fortress. This gives them optionality and safety that peers just don't have. 3. Production is growing. We are looking at 25 to 27 million ounces expected next year. Growth in a resource sector is hard to find. And 4. The moat of Juanicipio is working. It's a high-quality asset that anchors the portfolio.
Okay, play devil's advocate against yourself. What about the high costs and that PE ratio?
The high costs are a concern, absolutely, but I believe they are offset by the H2 production weighting.
How so?
As production ramps up in the second half of the year, unit costs typically come down because you are spreading your fixed costs over more ounces of silver. It's economy of scale. Plus, we are in a soaring metal price environment. If silver holds its gains or pushes higher, those margins will expand faster than costs can rise.
So the investment horizon here, are we day trading this?
No, this is a multi-year hold into the delivery of the 2026 guidance. You don't buy this for a week, you buy this to see them deliver those 27 million ounces.
That's the thesis. If you enjoyed this breakdown, make sure to subscribe, like, and comment to help us grow the show. We'll be tracking PAAS through that February earnings call, so stay tuned.
Thanks for listening, everyone.
See you next time.